Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And I know you're going to get tremendous value from the dynamic woman I'm interviewing today. Her name is Whitney Elkins Hutton, and she's in Boulder, Colorado. Now, she actually is the director of investor education at passiveinvesting.com, which is my friend Dan Hanford's company. And we crossed paths. We didn't get to meet, but we crossed paths at their conference a couple of weeks ago called MFIN. But she's that company's acquired over 4,000 doors, and Whitney's been in this for quite a long time. So I'm very excited to get into it with her. Whitney, welcome to the show.
Thank you so much for having me. This will be amazing.
Yes, it will. Well, so why don't you just take a minute and give us a little more background? You can do a much better job than I just did about, who you are and kind of bring us current. Just kind of high level overview of your bio, how you got into real estate, why you love it, blah, blah, blah.
Definitely. Well, as you stated, I'm the director of investor education at passiveinvesting.com. And that has not always been my course and trajectory in my career in life. I actually started out in my career path in the medical field, public health field, and stumbled into real estate entirely by accident in 2002. I purchased a house with a significant other, and about a month later, the relationship fell apart and the house was all under my name. And as you can imagine, back then it was the wild, wild west of lending. I was 103% financed. I didn't have any reason to actually own this house. Long story short, YouTube didn't exist. The house needed rehab. So I bought a Home Depot 1-2-3 book and rehabbed the house myself. Did a lot of things I probably shouldn't have been doing, but learned a lot along the way. And when I actually sold the house, which I think is probably my number one investing mistake, but hindsight's 2020, I made a $52,000 profit and realized I hadn't been paying for anything. I stuffed it full of roommates. I hadn't been paying for the mortgage, utilities, and if anything, I've been putting my money in my pocket every month. And it was after I closed that the light bulb went on. I'm like, how many more of these properties could I possibly do? So that just really launched me down the path as a real estate investor. I was able to make in 11 months more money than I was making in my day job.
When was that? Forgive me. When was that?
2002.
Okay. So this is all in 2002. Forgive me. Please continue. Okay.
Yeah, no, definitely. And so did several more projects on my own, living, flipping, and house hacking. I mean, I was young, single, and then met my husband. We did a few more together. The house we're actually living in, guys, if you're watching live, this is not my house. It's a green screen. I'm manifesting a dream here. But we're actually still living in one of our last flips because we still—
This is all in Boulder? Was all this work in Boulder?
Boulder, the Front Range, Fort Collins, Boulder, north part of Denver.
Okay. Well, we make fun of people from Boulder. I'm from Denver. I lived in Denver for 30 years. We called you guys granola bars, okay? Because it's
fair enough.
I'm sorry.
Yes, we are.
Yeah,
I get it.
There's a lot of eclectic stuff on that Pearl Street Mall and everything in Boulder, Colorado. It's a beautiful place. If you're listening, if you've never been, it's beautiful. But anyway, sorry I interrupted. Please continue.
Oh, definitely. We're definitely a mountain town that's in the middle of a metropolitan area for sure. Mm-hmm. But yeah, so it took us a few years to really realize that if we wanted financial independence to unlock those golden handcuffs, we actually needed to create stabilized, repetitive income coming in, which meant we needed to hold on to some of these properties that we were rehabbing. And we started doing that in Colorado. And then that's when I learned how to actually underwrite a property for cash flow and various other metrics, and realized that Colorado was not the best for rental real estate. So we started buying properties out of state and scaled to a portfolio of about 30 units, still doing flipping on the side to replenish capital, executing what we call the burn method. And we can go into that. So reusing our capital. And then it dawned on me one day that we had enough cash flow coming in that what I wanted in life 20, 30 years from now, I could actually start having some of that today, being home with my daughter, taking care of my family. And I started to step away from my job, spend more time at home. My husband was like, I want some of that too. And I'm like, wait, we need 80 properties to do that. So I didn't want to own 80 single family properties. So we transitioned to multifamily real estate and bought a 52 unit building with some partners. And that's really when the doors just blew off on the scaling piece for us. And we got into multifamily real estate, both actively and passively. And what I get to do today is really just educate investors or budding investors on the power of making that transition to active to passive, or even just leaping into passive investing in general, and just all the benefits that real estate can bring to them in their their investment portfolio.
Sure. You know, I got interviewed on a podcast yesterday and kind of got into it with the host because I said multifamily is just so much better than single family. I would love to get your perspective because you shifted from single to multi. You know, what I found in I've owned 2,000 houses. I had 500 houses in Denver at one time, actually. I can still name every street between Kipling and Havana because I had houses on most of them. But you know, what I realized was they just don't cash flow as well as multi. What was your experience?
Yeah, definitely. We're actually in the process of continuing to unwind our single family portfolio, at least the long-term rentals, and get into more lifestyle type of assets, ones that we can short-term rent and we can utilize ourselves, but also position that into more larger projects. Now, as far as directly answering your question, I think there's a benefit for somebody having both, right? Single family properties, for somebody just getting into real estate, it's accessible, especially if they've bought their own primary residence before. I even challenge if they've even rented, they understand it. It's tangible to them. It's not that hard. It's also an asset that you 100% control, right? You're maintaining all the day-to-day operational decisions on it. So I wholly believe somebody should keep controlled real estate in their portfolio. At some point in time, at least this is my journey, and a lot of other investors, I know have gone on the same journey, you realize that you just can't reach your goals as quickly as you want to through single family rentals, because it's not you're 100% occupied and 100% vacant. You're either making money or losing money. And it's that, because if you're vacant, you're still paying the bill. You have nothing to offset it. You don't have another tenant on the property to offset it. You have no scalability, having multiple units under one roof. You have, however many single family units you have, that's how many roofs you have, how many HVAC systems you have, how many water heaters, all those things can go wrong. But with multifamily, now you're getting elements of scale. Mm-hmm. If I have 1 or 2 or 3 vacancies on a 50 unit property, I still have enough income coming in to paying the bills. I just have less income coming in. Mm-hmm. Now, there are some cons to, transitioning into, multifamily real estate. And that is you're more heavily reliant on your tenant because you own a mini community. Mm-hmm. And if you get a bad seed in there, that can really kind of turn the tide on that property. And that's why I cherish the operators that I invest with and also partner with on the properties, because they're really very skilled at working with these tenants in the communities and keeping them, elevating them,
Yeah, that you're absolutely right. It reminds me of a story. We had an asset in Louisiana that 403 unit asset was just a train wreck. Should have never gotten into it. I mean, we made a good amount of money on it, but I remember literally offering 3 bad tenants that were living near each other that were just nightmare tenants, $1,500 a piece to be out by the next day. And they took it, just to help turn that thing around. Now, let me ask you a question back to single family for a moment. Did you self-manage or did you hire third-party property management for your single families?
When we first started transitioning our live-in flips into rentals, we started off self-managing.
Okay.
And that was because we were looking at the numbers. We're like, we can't pay a property manager. Now, when we started investing out of state, we needed to have third-party management. And that really came with one of our properties that we had here in Colorado in Broomfield. Broomfield, as you know, is probably like 15 minutes away from Boulder. But I have had a job, I had a child, I had all these responsibilities in Boulder. I'm like, when the toilet broke, I'm not going to go down there and fix it. I'm still relying on other people, third-party people, to go in there. And I'm like, well, what does it matter if I have, I'm not maintaining control of that anyways. I'm delegating it out. I might as well go through third-party management and figure out how to pay for that within the underwriting of the property. So
sure.
It was such a lifesaver for us.
Let me ask you this. Did you have a good experience? Because I can tell you, I've had lots of bad experiences with smaller management companies that just manage single family in multiple markets. I've had these experiences, and so have a lot of people that I've spoken with. Did you just have a great experience with that, or did you have some turnover in that management company?
I just actually switched managers on my last 10 units. And here's the thing is, in all of my working with all of my property managers, when I had my properties in Indianapolis, I've had some great property managers that were, amazing from beginning to end of the hold of the property. And then I've had others that were amazing at the beginning. And then I had to transition because they had some sort of issue in their business growth, or, the trajectory of their business went a different way and they started working with a different type of customer. So even if you have an amazing property manager right now, I always educate investors to plan for succession. Have somebody else in the clip, in your back pocket that you've already vetted that can at a moment's notice take over your properties if the initial property manager is not doing very well.
Yeah, that happens a lot. And it happens in the larger assets as well, not as much because they're more professional and sophisticated. And but in the single family world, I've seen lots of problems. You've got a broker doing it on the side, or very small company, and it's very easy to have an issue with it. So talk about raising capital, because that's kind of what you do. Talk about Dan has his no like and trust model. Yeah, why don't you speak about that? Because I think moving forward, finding the deals isn't going to be the problem. It's going to be raising the equity, because investors are afraid. And if you're an accredited investor and you're listening right now is not the time to be afraid. Now is the time to get excited, because like in our case, I've only purchased one asset in the last year in San Antonio, a 296 unit asset that broke even at 59% occupied day one. It's even better than that now. And just been investing final on numerous deals and scratching my head when I've seen what some of these properties traded for. And now we've got 2 properties under contract. I mean, because it's just opened up. The whole world has opened up. We've got a phenomenal deal in Nashville right now that we're going to do the due diligence on next week. But, talk about raising equity, if you would.
Yeah, definitely. So, for me, my background, I come from public health, and, that by no means is any sort of sales position. I mean, I didn't go to school in real estate or even private equity. I had no background in that. But what I did have a background in is how to relate to people and change behaviors. So because that is the root of public health, and getting people to change their behaviors, to prevent sexually transmitted disease or obesity, whatever. And that I brought that skill into my work when I started taking on the roles of with the previous equity group, director of investor relations and operations. And it's very similar to what Dan, his know, like, and trust triangle. I mean, I would say it's exactly the same. People won't make a buying decision, until they actually understand who you are as a person. Very few people are. And once they understand who you are as a person and who you are as a company, they have a decision to make. Do they like you or do they not? And whenever they can make that, have enough information to understand if they like you or not, now they can move on to the next phase, which is, can they trust what you're telling them about the deals, the conservative underwriting, how the lending is going to work, how the business plan will work. And once they can actually check off those 3 things in their head, then they move on to investing. Now, here's the thing. What investor has actually got a diagram sitting there going, okay, I know them, check. I like them, check. Now I trust them, check. Right? This is all happening at a subconscious level. Mm-hmm. So when it comes to actually driving that behavior change, for anybody here listening that is, trying to raise capital, you have to actually purposely lead the investor through this process. And so how do they get to know you? Well, this is by, kind of being everywhere at once, right? Being at conferences, being online, doing YouTube, doing a podcast like you are here. Mm-hmm. Can they get to know you? Are you, authentic and genuine, relatable in these conversations? Because, even then they're going to get to understand, do I actually like this person? Is this somebody I want to, do business with?
Right.
And once they start kind of checking those boxes, now they're going to hop on a phone with you, and then they're going to get to intimately know your company, take a look at your deals. And really, when you get them on the phone, they already know you to some extent. They probably have already formed some sort of decision in their head if they like you. Mm-hmm. Now they're already well down that rabbit hole of actually investing with you. And when they're actually filling in the trust part of that triangle.
Yeah. Very nice. Very nice. Yeah. Dan did a really nice job presenting that at the conference. What sorts of things do you typically communicate when you're talking to, let's finish that thought, but I do want to go back to Burr. If there's just a handful of people that don't know what that means, I can't imagine, but I do want to cover that real quickly, but let's just do that right now. And then I'll go back to my question. What is the Burr method?
Yeah. So the Burr method has been coined as a term probably recently in the last 5 to 7 years by Burr and turn it bigger pockets. But it means you buy a property below value, you rehab it to force the value on the property, you rent it, you put a tenant in there. Now you have a stream of income coming in. And now you can take it to the bank and utilize the income that's coming in on the property to offset the property expenses. And you can refinance all or part of your money out of it and reutilize the capital. Either maybe you're just switching loan terms, which is probably more what's happening right now for operators or individual investors. But in certain phases of the market, you can actually pull capital out of the property and take that capital into the next deal. So it's a great way to build a portfolio if you have limited resources. Now, and it applies to multifamily as well. Yes. And self-storage and mobile home parks.
Right.
Like it's just not multifamily, and it's not new as the last 5 to 7 years. This is what investors have been doing with real estate for hundreds of years.
Right. Like in our assets, we buy them, we reposition them, we get the net income up because all commercial properties valued on a multiple of the net income, and then we refinance in 3 to 5 years, get the investors all or most of their money back, and we're on to the next one, and then the returns are infinity. And so it's a fantastic model. And I know you guys do the same thing. It's a fantastic model that's proven for decades, like you said. And
to kind of stack on what you're saying there, you as the operator are doing that, but think about what you just did for the investor,
right?
The limited partner investor,
right?
They get to participate in that because now they have some portion of their capital returned, and now they can actually earn returns in 2 places, not only in that particular deal, but maybe a future deal. They can reinvest and just keep stacking that return. And like I said, if they've been paid back on one deal, then the return is infinity because they don't have any investment in there, and they can keep rolling that money. It's a phenomenal business model. Let me ask you this. What are your thoughts on the recession? How do you feel about what's coming? I know I'm more bearish than most, and I know at the conference most of the people were not bearish. Because of the pent up demand for housing and the job market and so on and so forth. I just, you don't know my story, but I lost a lot of money in 2008 and 2009. And so I'm dragging that bag of negative experience behind me. But I got to tell you, the last 2 years have felt like 2006 and 2007 to me. And, that frothing, that, and reminded me of Warren Buffett's quote, be fearful when others are greedy. There's been a lot of greed the last couple of years. And then, of course, people are starting to become fearful now. And the second part of that quote is be greedy when others are fearful. So what are your thoughts on all that? I think I sit somewhere in the middle. I'm not 100% bearish because, the underlying fundamentals are very different from 2008 and 2000.
Oh, yeah. Completely different.
Completely different, right? So, but you can even harken back to the Great Depression. I remember talking to my grandfather. Actually gave me the down payment on my first property, and he thought I was nuts. He was like, "Why would you do this?" And I was like, it was that transitional fear that, or experience, not even fear, right? That experience. Every investor is going to carry that whatever that belief system is forward. And that's the thing, is that is meant to keep you safe, right? So it serves a purpose.
It's a primal thing, really. It really is. But yeah, and I agree with you. Is it that it but that it's completely different. But let me throw this in there. There's been a lot of bridge debt the last year or two, and it's adjustable rate, and it's 18, 24, 36-month term. And they didn't require caps a year ago. They required them. They require them more recently. Mm-hmm. I think there's going to be some pain there. That's my 2 cents. That's my opinion.
I think there is. I mean, that doesn't relieve, even though the market is different. I think things are actually different from 2008 and 2009. Mm-hmm. If somebody is swinging for the fences on the deal and isn't underwriting very conservatively, maybe they're grossly overpaying for a property or grossly overestimating their business plan, or getting unrealistic.
Like hold on, sorry to interrupt you. Like I've seen pitch decks where they literally double the rent year one. I'm like, really?
Right.
Come on. Yeah. I mean, on a 200 or 300 unit asset, I mean, come on. Or 10% rent increases for 5 years straight. Really?
No. I mean, right. I'm sure you're like us. We're very much conservatively underwriting.
Oh yeah, totally conservative.
We're doubling market vacancies on our deals because, even though you may not
operating reserves, cash in the bank on each asset, we all of that, you've got to do it. And yeah, well, it's funny. You mentioned the Great Depression, and you triggered a memory for me. I lost my dad a couple of years ago. He was 90, but he lived through the Great Depression. And I remember asking him about it. This is, 4 or 5 years ago. We had like a ceremony for my mom and dad. And I asked him, what was it like to go through that? And he said he remembered a horse that he found on the side of the road, and he brought it home, and he wanted to keep it. And his parents said, there's no way, we can't afford to feed it. And my dad started crying. He said, wow, I don't understand why I'm emotional about this. It was a really beautiful moment. Like it triggered a memory that he hadn't thought of for, decades and decades. But anyway, that totally off topic, but it just, when you mentioned the Great Depression, it reminded me of that. But anyway, So I kind of cut you off. Did you have some more thoughts as far as the current climate with with this recession?
Well, I think, just to kind of finish my thought process there is, and you've already touched on it, there are a lot of people swinging for the fences. You need to be, focused on, especially if you're investing as a limited partner,
right?
You're giving up that day-to-day operational control of the deal. And so, you need to be with somebody like and trust that is actually underwriting very conservatively, that rent increases, the vacancy, using debt wisely. Now, I do like real estate in a recessionary environment because you have multiple ways that you're getting paid. Right. You have the cash flow, you have the equity, you have capital preservation. I mean,
no greater hedge against inflation, You
can pass through those costs to the end consumer, the tenant. So as far as, really in my mind, if you're looking for something to invest in, with all the other options out there, cryptocurrency, stock market, stocks, bonds.
Stocks are down 30%, crypto's down 60%.
Exactly.
No, come on.
Cash is king. We've already known that. So really it's compared to what?
Right.
What are your options? And so that's where I still see real estate as the best investment. It's pretty
no question. Yeah, no question. Completely agree. Agree. So here's a couple things, guys. If you're going to invest passively with someone, you should know a little bit about what the heck you're investing in. Now, I've got a resource for you. It's a list of questions to ask a GP before you invest. If you just text GP questions to 72345, it's a list of about 50, 60 questions, because you don't give your hard-earned money to someone without having some understanding of what it is, for God's sakes. I mean, people put their money in the stock market and a stockbroker convinces them to do that, and they're just a glorified salesperson, and they're not analyzing the markets and whatnot. But the other thing is, if I'm not sure when this will air, but if it's before my July boot camp, for God's sakes, even if you're investing passively, come to Denver, spend a few days with me, learn this business, so that when you see when you see an operator's pitch deck, you kind of know what you're looking at. You know whether or not they're being too freaking aggressive, like, these 10% rent increases every year, and no increases on the expenses, or low vacancy, while they're doing a reposition, or no operating reserves, and so on and so forth. Just so that you don't because there's going to be some people losing their money over these next couple of years. I know it with some of this bridge debt. I just know it. There's going to be some of these deals that go into receivership and get in trouble. So, I hate it, but it is what it is. I'm probably less. What's the word I'm looking for? Because since I lost $50 million in 2008 and 9, it's not as painful for me to envision it because, people need to take their hard knocks and move on and learn and grow from it like I did. But there's still going to be some pain. But now I know that you're really good at investor relations. Talk about some of the things that you do to enhance the investor relationship. Dan did a beautiful job at the conference I was at, and I would love to have you expand on some of that stuff for my listeners.
Yeah, definitely. So I'm really approaching this from an educational piece, not so much, from the sales side. So I'm really meeting the investor where they're at and trying to really listen to what they need and sometimes get them, what they actually should be asking for. So, really, I'm putting out a ton of educational content around making sure the investor wholly understands, like what you've already alluded to. Do you understand what a syndication is? Do you understand, how to actually formulate your goals? I think a lot of people come in as a limited partner investor into a deal, and they're starry-eyed. They're looking at the numbers, but they get into assets that actually aren't going to help them meet their goals. I really try to back it up. Good. I really help them back it up and actually focus there first, because if you understand what you need from your portfolio and what is available out there, now you can create alignment and you're going to sleep well at night whenever you have that alignment. And so I help them do that. I help them understand, the different business plans within passive real estate, because a lot of people, get themselves in trouble. They invest in a business plan because they're chasing a return when they, and really in their mind, they want to have a very core asset. Yeah.
And let me say this, operators can make returns look any way they want. And that's another reason you've got to educate yourself, because, they can, throw out these returns and just by tweaking a few numbers, make a pro forma look fantastic. And if you don't know what you're looking at, you could really be in trouble. And I know there's going to be people in trouble over these next couple of years. I just know it. So no, that's really good. I love the goal piece. That's really, really great advice. Dan also talked about, and this isn't in your part of what you do there at your company, but, talked about some of the things that they do to, enhance the relationship with the investors, put out a really nice high gloss newsletter, for example. They do in-person events. They, and try to verbally communicate with every investor rather than just have them, sign up on a portal like a lot of people do. And just, it's a lot of great pointers. I was really impressed with the presentation he put on about, when he was teaching other operators on how to do this properly. So
we're very hands-on with our investors. And so, we do have a lot of automation that runs in the background so we can, again, help people get the information they need in the time that they need it. But at the same time, we're really trying to meet them where they're at and reach out to each individual investor individually and create that relationship with them.
Right. Right. And that's the sales side. That's, you're in there building relationships and presenting deals and so on and so forth. And you're on the education side, which is really cool.
I get to have a ton of conversations about that goal piece. It's amazing.
Yeah.
I can remember 3 conversations earlier this week. Investors are coming to me and they're very focused. They've heard about this deal that we have maybe coming out, and they're like, "When is it coming out? I want to be there. Get me in on the early list." And I'm like, "Wait a second. I'm looking at the notes. We've had a conversation about your goals. Just want to make sure that we're still aligned here." And they're like, "Oh, good point." I'm like, "And here's some other things that we have available that are better aligned with what your goals are."
Interesting. And so how does that come into play? Is that the exit strategy for a particular asset, or the returns, or
boils down to tax benefits?
Benefits as well.
Yeah.
Got it. Okay.
And potentially the structure, because some of our deals, we actually have a 2-tier structure. Maybe a structure that, is a high cash flow, works a little bit more like a pref equity position. And then we have a second structure that, is, a class B that sits behind the class A. And so there's, inherently just by the positioning in the capital stack has a little bit more risk to it, but you get to participate in the upside. So I really hope, investors kind of connect those two dots based on their risk profile. And again, I'm not a financial advisor. That's not my role, but really trying to, kind of like a coach, turn the mirror back to them and say, hey, we have a conversation. Is this just double checking?
Well, that's really good too, and so like on that 2-tier system, what she's talking about, guys, is, they might have a pref equity piece where they get, they're in the A stack. They get paid first in case if something goes south, but also I'm guessing that the returns are maxed. So it's like they get a pref of this at say 8% maxed out at 10 or 12%, and then they're out, and then it's return of capital instead of return on capital, versus someone in the B stack that may not have the priority, but they're getting their pref and they're getting to share in the split down the road. So is that kind of, did I describe that correctly? Yeah, that's a really, a lot of people just want to know that they're going to get 10% or 11% or 12%, and then they're fine with that. Others want to participate in the equity. Well, listen, Whitney, it has been a real treat to have you on the show. I appreciate you sharing your knowledge, and it's a pleasure to meet you. I'm sorry I didn't meet you in the Carolinas, but thank you for coming on, and hopefully we'll cross paths again very soon.
Absolutely. You're going to be in Denver in July. We should connect.
Oh, that's right. Yeah. You should come. You'd have a blast, but it'd be pretty much very rudimentary for you. But I do get a lot of established operators that go and network and whatnot. But yeah, if we can, we should definitely do that. It's a pleasure to meet you, Whitney.
You too. Thank you so much for having me on.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 72345, and we'll set up a call so you can check us out and we can check you out. That's mentorwithrod.com or text CRUSH to 72345.